All right, all right, all right. As people are connecting here, I will offer greetings. It's Mark Yusko from Chapel Hill, North Carolina, here for Around the World. So much for sell in May and go away. The relentless summer melt up. LJ and I were literally just talking about how hot it is down here in North Carolina, South Carolina. So steamy. Actually, I think it's the most humid I remember in the 30 years I've been living down here. I mean, it's crazy. And then it's gray and rainy on top of it, but maybe that's why it's so humid. There's just a lot of water. But we're going to talk not about the heat and humidity, but about hotness in the markets. This incredible melt up that we have witnessed, one of the greatest of all time. So on the left-hand side up here, you got Trump making his deals, Monty Hall. For those of you who grew up watching Let's Make a Deal, like I did. And on the right-hand side, the everything rally. I mean, everything is at all-time highs as we sit here talking, and maybe not exactly at the all-time high, but within the last 48 hours, just about everything has reached an all-time high. So much for the sell in May and go away, and don't come back till St. Ledger Day, which was the quote last month. It's a bit hard to believe, but the main risk at this time may be a stock market melt-up, i.e. a speculative bubble. That was Ed Yardeni. Now, he's always bullish, but he actually said that on June 30th, so not that long ago. Bull markets ignore bad news, and any good news is reason for further rally. For Michael Platt, the longer the bull market lasts, the more severely investors will be affected and with amnesia. After 5 years or so, many people no longer believe that bear markets are possible. That's from Ben Graham from 70 odd years ago. In investor behavior, particularly during the last stages of a great bull market, perception of risk and actual risk become at the opposite ends of the spectrum. From Leon Levy, famous investor, when an epidemic of high turnover speculation has displaced long-term investment as the standard conduct in the financial markets, the end game is always never pleasant. So we'll see where we go. So, we started this year after the 10 surprises talking about tariffs everywhere. From the water everywhere. Trade wars are good and easy to win. The Donald loves the word tariff. And everybody else warned that benefits of tariffs just don't exist. It escalated from there into March with is the investment environment starting to stink? Markets were headed down. You got Scott Bessent and Elon and everybody on the right-hand side befuddled by what's going on. And, Reagan summed it up best saying, look, at first, people think tariffs are a good idea. The problem is, like most things artificial, they discourage true innovation, and you end up losing more jobs than you protect. And that was all the way back from 1987. So by April, it was, will the economy sink? And even the Donald was probably thinking, all right, I lit this thing on fire. Maybe it wasn't such a great idea, and he couldn't figure out how to put the puzzle back together. Look, Adam Smith says that it just doesn't work. It's disadvantageous except to those that can't compete, which is kind of the way governments work in their late stages. So how it ended, so to speak, tariff on, tariff off, wax on, wax off. So the Donald just said, you know what, fine. We'll just extend everything in May, and so much for sell in May and go away. It was basically off to the races. Xi Jinping said, look, there was no winners in trade wars. You just get self-isolation, so you should probably not do this. And Trump kind of gave in. So the never-ending story, though, this thing called Taco Tuesday. So Taco, Trump always chickens out. He threatens tariffs, and then he takes them off. So we talked about, how the never-ending story went down. Then last month, we talked about, mid-year update on global markets. The Taco Man was back. He was back in and this is kind of how it restarted. It was the bear market was not pleasant, and he likes to make money, so we're going to send it back to all-time highs. And we did say, sell in May and go away, don't come back till St. Ledger Day was what people say, but it didn't matter. So, as we've discussed since the beginning, tariffs reduce growth and prosperity. And the taco guy has been real, right? He threatens, chickens out, and when he chickens out, the market booms. And the reason is, if you actually went through with the 145% tariffs on China, it would be the largest tax increase, second largest in history, and the largest since the 1960s. Now, all that said, we had to acknowledge last month that markets had come back all the way back to Liberation Day. So, he punished the markets on Liberation Day, quote unquote, liberated people from their profits. A lot of people bought the dip and are right back to where it was. The real problem was valuations got back to danger zone level. I mean, we've really never seen valuations in the US and the world on the right-hand side. They're in uncharted territory. We're in that upper 5% of history, and it's just not really great. Now, at the end of the day, the tariffs are going to end up being higher than people think, and they will generate some revenue. They have generated some revenue. And I love this part. So on 7/30, which is, again, not that long ago, on 7/30, Trump said the August 1st deadline is the August 1st deadline. It stands strong and will not be extended. A big day for America. And then literally, you can't make this up, on Taco Tuesday, he changed his mind. So, markets are rocking. So I guess it's just a ploy. And I guess if you're allowed, I guess that's okay. It seems wrong to me, but whatever. Math is really hard. I mean, the Donald is an interesting guy. I mean, I get it. He's prone to exaggeration and he's prone to hyperbole. I mean, I like hyperbole as much as the next guy, but in this quote on the left, trillions of dollars are being taken in on tariffs. That's just blatantly not true. I mean, it is billions, and we'll talk about that in a second, but it's not trillions, and it's not gonna be trillions. And I just think, trillions, billions, whatever, it's huge and good, and there's no inflation. He says there's no inflation. Tariffs have not caused inflation. Yet, literally this morning, PPI came in super hot, 3 times estimates, and core CPI jumped back outside the 99th percentile of the last 20 years. So there is inflation, and just saying there's not doesn't make it so. And it says customers aren't even paying these tariffs. Again, that's just not true. So I get it. I guess you can, free speech says you can say whatever you want, but there's fact checks. So if you don't eat, put gas in your car, pay utilities, tuition, or rent, you're right, there's no inflation. So in 1 year, meat, and granted, meat is just one thing, but it's a pretty meaningful part of, people's diets and grocery bill. So instead of 2.7%, it's 50%. Now, part of that is there was something that happened in the Biden administration. That doesn't mean Biden did it, but in the Biden administration, there was something that happened where they called the cattle herd. Some said it was conspiracy, whatever, but they did do that. And that, because my friend is in the beef industry, and he said they were forced to kill a bunch of cows. So that is definitely part of it. That will fix itself. It takes a while to grow a cow. The right-hand chart is the tough one, though. if you measured inflation the way we used to before we took out food and energy, inflation would be closer to 6% than the quote unquote 2.7%. That's still really high. Anyway, so tariffs at the end are a tax. And on the left-hand side, you can see the core CPI above inflation, PPI the hottest since 2022. And yet the president wants 300 basis point tax cut. I mean, tax cut, interest rate cut. And he said he's going to fire Jerome Powell, which he can't do. And Jerome's still there, hasn't resigned. Um, and the evidence of tariff pass-throughs is mounting in the final demand data in the PPI. So it could get ugly fast, but we'll see. All right. So let's go through quickly kind of global markets. So, the recession we thought had a chance of coming. Poly market says zero, not zero, 12% chance. And, global GDP has rebounded very sharply from the contraction in first quarter. So the U.S. did contract in first quarter. It was revised down from 0.3 to 0.5, so worse than expected. But second quarter came in hot at 3, not awesome, not like, India or China, but 3 is good. It's a good number. The problem is maybe the data is bad because the ISM data, and these are, data from manufacturers and service providers, both of them are in the recession zone and both are weakening like we've never seen. So on the left-hand side, the manufacturing plummeted all the way to 43. Again, we've never seen that level without calling recession. And on the right-hand side, not only is the services number sub 50, but the prices paid component, the inflation component, is surging out of control. So quo vadis, where from here, we'll see. Job market been deteriorating all year, particularly for young people. I mean, if anyone has a young person in their life, it is super hard for recent grads to get jobs. One of the toughest job environments literally since the global financial crisis. Job numbers have been revised down in 24 of the last 31 months, and we are reaching levels of joblessness like global financial crisis, even though we're quote unquote not in a crisis. Leading economic indicators haven't declined for 4 years, again, ever in history. And the last 2 times when they declined for 3 years, we declared recession. So we're not in recession and no one thinks we can be in recession, but I don't know, maybe we technically are and NBER just won't call. I don't know. Loan delinquencies on the left-hand side, credit card debt, the student loans, right? They told everyone you didn't have to pay your student loans and then they were going to forgive them. And they said, oh, sorry, we're not going to forgive them. And you have to pay. And people said, screw that. I'm not paying. So come get me. So that one I get, but auto loan delinquencies and credit card delinquencies, those are bad. And the companies are the ones that feel the heat. So small businesses are declaring bankruptcy at the fastest pace in, coming up on 2 decades. And if you think about the impact of tariffs, it has a bigger impact on small business than it does large business. Now, the Atlanta Fed and small business CEOs, interestingly, both say party on, Garth. The consensus is less sure. They're saying it looks more like 2001, where we could have a blip down in third quarter. Remember, 2001, first quarter GDP was positive, first quarter was negative, second quarter was positive, third quarter was negative, exacerbated by 9/11, and then fourth quarter was minorly positive. In the end of the year, we're 1% positive, but that's a recession. So over the next 12 to 18 months, despite the fact, I love this, on the right-hand side, despite the fact that the CEOs are optimistic, they are preparing for a recession in the next 12 to 18 months. So it's kind of contraindicators. Printer is coming. Look, Powell still in office. They threatened to fire him. They they spread rumors. Bill Pulte spread a rumor that he had sent a letter of resignation. Clearly, he didn't. So they've tried everything to get this guy to quit. And I kind of admire the tenacity. Um, and Powell, I think he's not going to be in a hurry to cut rates, no matter what people say. The market is pricing in 2+ cuts by the end of the year. And in fact, they're saying 80% chance that he cuts 25 basis points and another 11% chance that he cuts 50 basis points. And actually, crazy people, I shouldn't say crazy people, interesting people are actually placing bets, like literally buying options bets that he'll cut 50 basis points in September. I mean, that's just gambling, unless someone has inside information, but that's anyway. So despite all that rhetoric, USM2 just hit a new all-time high, left-hand side, 22 trillion. That's a real T, trillion, not the fake T. That's real. And the money supply growth rate still sub 7%. It's around 6 or just over 5.5%. That's quote unquote golden. So that shouldn't cause a lot of inflation, although 2.7 is more than 2, which is the target. The constant devaluation of the currency, meaning that 6.5, that 5.5, 6% growth, actually long term since 2020, 4.5%. The dollar is declining in value. Now, given all the rhetoric about we need a rate cut, we need a rate cut, we need a rate cut, the liquidity, left-hand side, gold line, is reaching levels where we can't juice it much more. I mean, the Fed has been doing everything they can behind the scenes in terms of kind of not QE to juice liquidity, and they're helping the banks by not having them write off all their bad loans. I'm not bad loans, the losses on their treasuries. So there's a lot of funny business going on, but financial conditions on the right are the lowest are the easiest they've been since 2022. So why is the Fed sweating it? Why won't they just give in and do what everybody wants and cut rates? Well, it's because the swamp didn't get drained. And the real problem is we are incurring the third largest budget deficit in history. And, the biggest was the massive stupidity of 2020, where we quote unquote, bailed out the world from COVID, which we didn't need to do, but, we printed a lot of dollars. And look, that was a direct transfer of wealth from the poor to the rich. I didn't put the slide in, but the percentage of wealth that's gone to the top 1% is over 50%. And then the next 49% is like, the balance, and only 1% has gone to the bottom half. So the stuff that people own went up because they devalued the currency. The stuff that people need got more expensive, so the poor got poor. The real problem is the government is about to get super poor. And you think we have a spending problem now, wait till 5% interest rates start to kick into the interest expense. And we get to, we've never been higher than 3.2% of GDP. Wait till we're at 3.5 or 4 or 5. Unsustainable. So everyone's excited about the left-hand chart. Oh, yay, we brought in 30 billion. Okay, now 30 billion is not trillions. Let's just be clear. 30 billion is not trillions. But it is $30 billion. That's not nothing. The problem is they're spending it, the big beautiful bill and all of the nonsense. I mean, I love the quote at the bottom. If you made $500,000 per day, every single day, since the Great Pyramids were built, you would have less than half of what the U.S. government borrowed since June. Just let that sink in for a second. I mean, this is emperor has no clothes writ large. I mean, it's unbelievable. So last time global rates surged back to this level, we had the global financial crisis. So global central banks are doing their part other than the US. Everybody is cutting rates. I mean, far right hand side. I mean, literally everybody in the pool is cutting rates. So, and China makes the Fed look like amateurs. You look at USM2, which I showed you is, 22 trillion, which seems like a lot. Chinese M2, there just aren't words for the dragon jaws there. And don't fade the global money supply wave. So the global money supply in green is reaching levels that we never could have believed. And it's really all since the turnaround on Taco Tuesday in April. So bonds, they're having a tough year. Actually, they're having a bad 10 years, the worst 10 years ever. But the alligator jaws or dragon jaws on the right-hand side are as extreme as they have ever been. And you know what happens. There are no examples where the gap stays open. It always closes. So look, Buffett has been accumulating cash like it's going out of style, pun intended, and it is. And he's up to over 32% of, I'm sorry, 38% of total market cap. So 38% of every dollar you invest in Berkshire, you're just getting cash that's devaluing every day. And therefore, Berkshire is underperforming the S&P at its second worst level in history. The other three times it underperformed the S&P, look at that, dot-com bubble, global financial crisis, and COVID pandemic. Those are interesting bear markets. So I'm not saying this has to happen. Well, yeah, it kind of is. So the bear and the maiden fair, bear was in ICU. How does he get out? Look, the bear was out of ICU for literally a single day. We had a 20% correction for one day. Taco rally, Mag 7 up over 50% since the Taco Tuesday. Triple Q up in the mid 30s, and even the mid 40s, and the S&P up a sweltering 30%. Investors love tacos. The April-May rally was one of the sharpest in history, and so much for sell in May and go away. The markets jump, right? The S&P up 16%. The Mag 7 surge, Triple Q up 28%, but the meme stocks go crazy. I mean, the meme stocks on the right-hand side, Robinhood, SoFi, Palantir, ARK, Carvana. I mean, these things they make 28 and 30% returns in the S&P and the Triple Q look pedestrian, crazy. Now, the S&P has made a new all-time high just about every week. Greed, way back in vogue. So is it reflexive? Are the valuations high because pension funds went all in? Or did pension funds go all in because the prices are high? It's an interesting, philosophy question. So everyone in the pool, we're on pace for the biggest inflow into U.S. equities in history. And the U.S. market today is now bigger than all of the other major markets in the world put together. And look, if stocks are a good bet, then leveraged stocks are a better bet. And if I can buy leveraged stocks on margin, we now have over $1 trillion, there's the T word again, $1 trillion of margin debt. When the margin calls start, if they start, that will exacerbate the problem. Everybody loves stocks. NASDAQ surges. It's up a lot. Even small caps have erased all of their losses. Now, look, on the left-hand side, the S&P, particularly tech, earnings are going up, double digits. Oh, okay, that's good. But small caps, lower right-hand corner, 42%, not only are earnings not going up, they don't make any money at all. It's kind of bizarre. Um, Average valuation. So if you look at all the different indicators for valuation, we are now back at the all-time high, saying we need a 59% correction just to get to fair value. And you know, we always go one standard deviation below fair value. So that'd be in the, 75+%. And when you think about PE ratio, it should be correlated to inflation. So if inflation is low, if we were sub 2%, you could argue that you could have that sweet spot of the dark teal colored and you could get to a 25 PE. When you have a 42 PE and you have inflation coming up on 3%, it's happening. So I'm not saying it's not happening, but it defies logic and it defies the long-term trend. So the Buffett indicator has totally lost the plot. So the Buffett indicator measures, this was his favorite indicator, that's why it's called the Buffett indicator. It's basically market cap to GDP. And the market cap should be about 70% of GDP because it costs money to make money. And you could argue that because of leverage and because of market capitalization, passive indexing, all that, maybe you could justify 100%. But we just passed 200%. And so the numbers that were bad on the right-hand side are now worse. So now we're not in the top 5%. We're coming up on the top 2 or 3% of all-time off-the-charts high valuation. But not everything is rallying. The transports are flat year to date. FedEx and UPS are down bigly. Now, I'm not saying you should rush out and buy these, but you might. I mean, these are trading like we're in a recession. So if we're not in a recession, these are probably relatively a good value. So that's interesting. Healthcare, checked into sick bay. Look, UNH gave back 5 years of gains in a matter of weeks. Now, I would not be upset if this company went away, but I don't think it's going away. And as an investor, it's starting to look kind of interesting. First time in forever, like literally first time in forever, the rest of the world is beating the S&P. And I think, so that's the left-hand side is just saying that the U.S. has been outperforming pretty much for, 35 years. And the last 15 years has since, 2009 had just been cray-cray. And it can't go on forever. And it, things that can't go on forever don't. And so we are having the second worst year of the U.S. relative to the rest of the world in history. This is crazy. So it's, even though we're having a melt up and even though stocks are up 10%, they are trailing the rest of the world by a lot. Now, the problem with the rest of the world is it's all just multiple expansion. So it's it's not just the rest of the world. It's everywhere. Everywhere it's just multiple expansion. It's not that earnings are surging. It's that multiples are expanding because people think rates are going to go down. But if rates don't go down, then why do you keep expanding the multiple? I don't know. So despite all that, the financial planners are now tweeting out, don't worry about bear markets. This was literally the quote. You should just not worry about bear markets because look, I mean, the bull markets are so much better. Now this ignores the math, right? Now, if you're down 50%, you got to be up 100% just to get even. So, you look at that one in the middle. Okay, if you went down 47, yes, over the next 5 years, you went up 121, but you were barely above even for, almost a decade. That's not a great return. But hey, don't worry about bear markets. Just ignore them. So I shouldn't pick on Charlie because he's a good tweeter. We thought MAG would stand for must acknowledge gravity. Hedge funds, they piled back into the MAG 7 in May, but who could blame them, right? I mean, these were the best companies in the world. Now, QQQ hasn't closed below its 20-day moving average for 60 days. Only one other time did it go longer, in 1999. So again, I'm not saying that it has to collapse tomorrow, but I grew up in the age of streaking where people ran around naked outside. Um, this is the emperor wears no clothes. He's kind of naked, and a little kid's going to say at some point, "Hey, you're naked, so let's put some clothes on." The 10 largest companies as a share of the S&P, they make the dot-com bubble look silly. I mean, at 40%, everybody is all in on a small number of companies that are priced to perfection. Now, part of the magic is this great trade of buying back your own stock. Well, who are you actually buying it from? Well, you're buying it from yourself. So the insiders, the CEOs and the CFOs are selling. The company's buying it back, which makes the price go up. And so the options that these guys have goes up and they just, lather, rinse, repeat. So it's a great way for rich people to get richer for sure. Not so sure it helps the rest of us, but in the short term, it's good. Retail investors, feeding frenzy. I mean, they are chasing levered meme stocks, single stock options. I mean, they're YOLOing into stuff. Palantir has become Tesla-esque. I mean, everybody loves Peter Thiel now. Everybody loves Palantir. It's got a 613 PE. I've actually never seen a stock with a 613 PE, especially one that has a dubious business model. Now they do have an advantage that they're all tied into the government, but they only have one customer. I mean, not just one, but anyway, I don't get it. And look, maybe I just don't get it because I missed it and I'm a value guy. But Carvana was deep value, down 99.9%, but now it's up 10,000% off the bottom. Again, this company destroys cash. I mean, they incinerate money, but it became a meme stock, and man. So dollar, we thought that the dollar, after being super strong last year, would shrivel back to banner form. Look, the dollar is in a downtrend. It's been in a downtrend really for the better part of 40 years. It was actually having its worst year in history. And the first time on the left, the black line, the dollar got strong. Trump was talking a big game and the dollar went up and he said he wanted a strong dollar. This time the dollar's going down, and it's going down hard. And weak dollars are only good if you export a lot. And we actually don't export a lot. So that's the problem. We buy a lot, and we buy a lot from China, which we'll talk about in a minute. So I think this is not a great trade, but whatever. Dollar gave back all the 2024 gains, on the verge of being negative for 10 years. It's the furthest below its 200-day moving average in 20 years, but everybody's short. So at some point, it probably will get a bounce, but not yet. Digital asset revolution, will it save the dollar? Stable coins will be US dollar based. This actually is a good plan, right? If your dollar is toast and you've printed so much of it that it's toilet paper, why not get people to exchange this new digital money for fiat, or have the fiat, have the digital money be backed by fiat? So what a stable coin is essentially is a digital form of fiat, not like a CBDC, which would be evil and controllable. So this is the best form of a bad structure. I still don't want to own fiat, but this is going to be a big deal. Well, who are the biggest winners of this genius bill? Coinbase and Circle, both of which have surged again bigly, giving back a little bit of their gains, but still up a lot. 100 billion or 90 billion and 50 billion market caps. Ethereum might be the biggest winner in the stablecoins race, and on top of it, a bunch of people have now copied the Michael Saylor playbook and tried to do Ethereum treasury companies in Ethereum. So the most famous is BMNR, Bitcoin immersion, which Tom Lee, the guy on CNBC all the time, basically became chairman of, and in a month took the stock from $4 to 70. So look, he made a big bet. Now, he was an early digital supporter, big Bitcoiner. He converted this Bitcoin mining company into an Ethereum. He says now that Ethereum is the biggest macro trade for the next 10 to 15 years, which is not actually a ridiculous statement. Now, the fact, remember that Peter Thiel is intimately involved with this, and that Vitalik was a Thiel fellow when he invented Ethereum. It all kind of ties together. So betting against Peter Thiel has been very unprofitable. So this BMNR, I mean, the guy stepped on the board, probably got a big stock grant, announced that Bitcoin was, or that Ethereum was going to $500,000 on television. And the thing went from $4 to $71 in 5 trading days. It's a big deal. So, I mean, maybe it's a pump and dump, but it's a big deal. So oil, the Saudis need it to go up, but it is just not. So oil collapsed on trade war fears. It came back when the tariff pause, but it's trading like we're in a recession. And on the right-hand side, Bitcoin priced in oil, which I think is a really interesting dynamic. People think of oil as this big, valuable commodity, but if you price Bitcoin in oil, Bitcoin just made a new all-time high. Now, the EIA says that oil prices are going to steadily fall to $60. I mean, we're already there. And they basically say it's because demand is not growing as fast as production. Well, why is that? Can't Saudi just turn off the tap? Well, the problem is they kind of aren't really pumping the spare capacity in OPEC. And every time Saudi doesn't pump a barrel, someone else in OPEC cheats and sells it. And it's just a game of who can sell the last barrel. The real issue is, I mean, this is a miracle. I mean, literally is a miracle. From 2009, when we were down at, 7 million barrels a day, to today, almost 21 million barrels a day. It is a remarkable feat. I mean, and we're doing it with less wells. We're doing it with less CapEx. I mean, it's remarkable. And so that relentless supply growth is just tamping down the price of oil. Now, oil stocks, they were an interesting buy on the tariff flip-flop. It was a 30% trade. They couldn't hold the 200 day. So I'm less excited about that today. I still like the MLPs. They're just going to give you double digits. And, not that 15% is all the rage, but it's a good return. All right. Crafty Christine finds a way to outcut the global central banks, and Europe outperforms. I mean, I got to hand it to her. I mean, for a country, for a collection of countries where growth is moribund, I mean, Germany's still in a recession, like literally in a recession, and there's not a lot going on because they're not selling as much stuff into China because of the trade war that they started by trying to tariff Chinese cars. It's been spectacular, and the European banks, which are not really very good, have been nothing short of scorching. I mean, just completely en fuego, up 70+%. I guarantee the average person did not have Greece as their number one best performing market this year. No pundit was talking about that. And other than, Poland, which is kind of interesting, you basically got Greece and Spain and Italy at the tippy top. So the peripheral European markets, the vacation islands, have been a really good play. The Night of Seven Kingdoms. Look, the problem with Japan was Ueda-san was an academic and wanted to stem the downward trajectory of the yen. And the yen needed to flip in order for the stock market to go up. Now, he either got beaten into submission by the PM or I don't know, something happened. But now the yen is steadily devaluing again, and Japanese equities made a new all-time high yesterday. So that's a good thing. And look, Japanese equities, particularly the tech stocks, are trumping, pun intended, the US stocks this year. And it's not close. I mean, SoftBank, Nintendo, and look, Nintendo, release of the Switch 2, great product, great launch. Lots of people buying it. Couldn't get one for weeks. Sony, I mean, just on fire as well. So they're good companies. Now, Japan is this, what this chart shows is when you are in a massive stimulatory create M2, what happens is all your stuff theoretically goes up. Your real estate goes up, your stock market goes up, but at the end, your money is devaluing so fast that if you price in real money, like gold, you're not making anything. So the same is true of the US. The US stock market looks like it's making new all-time highs, but if you price it in gold, it's the same price as 1996. So it's just a reminder that you got to always bring it back to money, not the currencies which are being devalued. So the dragon and the wolf, Shanghai index continues to fly. China's trade surplus, just to something that no country has ever done. This is the law of large numbers. $1 trillion surplus, actually 1.2 trillion. Now, what are the benefits of a trade surplus? So one, you get better economic growth. Two, you get better employment. Three, you get a strong currency, which is partly why the dollar is weak, because we're not doing this, because we have a trade deficit. So we print fake money and we buy real stuff. And it means we have decent life, but we're basically transferring wealth to the trade surplus country. And it's a virtuous cycle. So why did Trump extend for 90 days? Well, he had no choice. If he hadn't extended, right, if he said August 1st is August 1st and I'm not going to back down, then we would have had 145% tariffs on Chinese goods and U.S. consumers would have went batshit crazy. Now, what it also does is this series of 90-day delays has basically given China time to move their supply chain and their trading patterns. So they're now trading more with Russia, Europe, Asia, India than they are with the US. And in fact, they're skirting the restrictions by sending stuff to Vietnam and Indonesia and Taiwan, and then it isn't from China. And we buy it. So it's kind of clever. Despite the trade war volatility, Chinese stocks up 3 times more than U.S. stocks. David Tepper is very, very happy. And animal spirits have even come back to the local markets. The A shares have broken out of that wedge pattern and are, again, scorching. The terrific 10 have been volatile, but they have beat the magnificent 7 by a meaningful amount. I mean, it's, 50%, 35, 40% is better than 20%. I mean, not that 20 is bad, but that's pretty good. Breaker of chains, Bitcoin adoption, it's moving along. BlackRock now has the fastest growing ETF in history. There've been a lot of ETFs. The IBIT is the fastest growing in history. It's also the 20th largest ETF in the world. Remember, this is the one that everybody said, no, we can't do it, And that's the 20th largest in the world. And it's not been around that long. Now, digital liquid protocols just topped 4 trillion. Again, real T. Interestingly, Bitcoin alone is bigger than all the others. So when you add Ethereum plus stable coins plus everything else and all the, quote unquote shit coins and all of the altcoins, Bitcoin is bigger than everything else combined. That is information content. Bitcoin looks pretty big, 6th largest asset in the world. until you compare it to the rest of the world, where in a 1,000 trillion, so in a quadrillion-dollar world, 2.4 trillion, sorry, 2.4 billion, no, 2.4 trillion, I was right. 2.4 trillion isn't that much. Now, 2.4 trillion is pretty amazing from zero in 2009. And in the middle, we already flipped Amazon at 123 and now we're back below it. But at 158, it flips Apple. At 191, it flips Microsoft. At 217, it would flip Nvidia. And at 1,000,001, it would be bigger than gold. It would be the biggest asset in the world. So Bitcoin broke out of resistance, new all-time high in sight. I made that slide yesterday, and then we hit an all-time high, and then we're a little bit back below it. So what happened yesterday is Nakamoto. So Nakamoto, full disclosure, I'm a board member, and it is a Bitcoin treasury company run by the Bitcoin Magazine guys. They got their final approvals, and they went out in the market to buy $1 billion worth of Bitcoin. David was very vocal about it. And when you tell everybody you're going to do something, they kind of front run you. So, it was a tough execution day, but he could say they bought $1 billion of Bitcoin, which is a pretty cool thing to say. Bitcoin price highly correlated with global M2 with about a 117-day lag. 100 firms now have Bitcoin on the balance sheet. Relentless stacking, over 1 million Bitcoin. That's pretty cool. Metaplanet, again, board member, number 6, and ProCap may or may not be a board member. That's Pomp's company, number 16. So Bitcoin treasury companies follow a standard path. They start volatile, and you can take advantage. Volatility is vitality, and then they roll down the curve into stability. Even in stability, you can still generate great returns. So look at the top dog, which is MicroStrategy. Very low volatility at this point. Dramatically outperformed traditional finance. So in the last 5 years, you basically did almost twice as well as Bitcoin, which is, well, how is that even possible? I'll explain in a second. You did about 4 times better than the Mag 7, about 6 times better, 7 times better than the S&P, about 10 times better than gold. So it's just not close. And how does it happen? Well, what MicroStrategy has done is they use intelligent leverage, all right, to get you a better return than just owning Bitcoin. They actually do it in a pretty interesting and tax efficient way too. And it's included in a bunch of indices. So there's passive flows into it, kind of just like NVIDIA, and that the ETFs and Bitcoin itself don't have. So I'm not saying you should sell all your Bitcoin and buy MicroStrategy. That's not the point. And part of it is the genius of the right-hand side, which is, so what happens if the MNAV, the market cap to NAV, fluctuates? Well, he's like, well, I got that covered. I got equity, I got preferred stock, I got convertibles. And depending on how high the premium is, when the premium gets really high, if you'll give me $4 for every dollar of Bitcoin I have, I will issue stock, dilute myself, and buy more Bitcoin with free money. If it gets below, I will just repurchase my equity and issue converts. So he's got this beautiful capital structure. He's basically created an efficient capital structure for the digital age. And the colors don't match here. The slide, it was kind of funny. They should have used the same color in the left slide and the right slide, but they didn't for some reason. But the bottom line is you have Strike, right, which is the 8% perpetual call option convertible preferred. So basically you can get 8% dividend guaranteed by Bitcoin and guaranteed by MicroStrategy's holdings. So you get pristine collateral as opposed to high yield bonds or other things, REITs, for example. Then you've got Strife, right, which is the fixed rate preferred, a 10% dividend. That's a pretty interesting security, and that's growing quickly. And then you've got Stride, which is the junior fixed preferred. So you can choose where you want to be in the capital stack. Do you want to be senior in the capital stack? Do you want to be junior in the capital stack? And it's a really interesting dynamic way for traditional fixed income owners to diversify into the digital age. Metaplanet running the same playbook to perfection. And, it's given back some of the crazy, crazy gains, but it's still up a lot, hundreds and hundreds of percent year to date, and is one of the fastest growing global equities, just period, in terms of numbers of shareholders and adoption. And they are now introducing the MicroStrategy playbook into the Japanese capital markets. Why does this matter? Well, the Japanese capital markets have been moribund for years. Interest rates are super, super low. People can't get any return on their savings. Now, they don't have a lot of inflation, so they're not really losing, but they're not gaining. Well, inflation's coming back, and Mrs. Watanabe, the mythical lady who runs the household, is probably going to diversify into these preferreds and converts that Metaplanet is going to issue in coming months. Look, Simon's a mad genius. He's basically copying the Sailor playbook, who's a true mad genius. And this is going to be a story that will be written about for decades in Japan. It's pretty awesome to be part of. The bonus, gold prices go up to look, they blew right through 3,000 before the ink was dry on our first presentation, but we've been stuck in this rut, between 3,200 and 3,500 for a while, 3,300 and 3,200. And rock beats paper. Gold has actually outperformed financial assets this year, shockingly. Most people would say stocks are up more, but they're not. And for 25 years, you could have done twice as well. Let's let that sink in for a second. Twice as well if in 2000, you just, when Julian shut down his shop, you just took all the, gains you got from investing in Tiger and put it in gold, you would have done twice as well as the S&P. It's extraordinary. Now, humans love to buy what they wish they would have bought. Gold flows were huge, but on the right-hand side, not compared to equity flows. People are still so dedicated to equities that they just can't help themselves, despite valuations, despite everything else. Gold is money, but gold miners are scorchingly hot, up twice as much as gold this year. And the amount of money that they are printing is pretty extraordinary. So at these prices, the miners literally are minting money for the first time. Revenue growth is the highest, it's near the highest it's ever been. And the margins are extraordinary. So this could be big. Now, just one quick thing. So we talked last time that, Trump announced this 50% tariff on copper, and copper had its biggest move ever, and everybody complained. Well, and somebody knew about the tariffs beforehand, so they bought before everybody else. But then somebody complained, and taco actually applies to the copper tariffs. So we had the best day in copper's history, followed by the worst day in copper history because they exempted refined product. So be careful what you invest in when there's regulatory and the, predilections of an executive order. So copper stocks were liberated from their gains, then restored, and then liberated again. All right. So latest podcast is up on Around the World. Hedged just did a new podcast on the mid-market update with Corey. And then every week we do the digital currents. And last week we talked about Bitcoin and mining and a bunch of things. There's that. And I thought I saw some questions. Where's my thing? Thought there were questions. If there are questions, throw them in. Good to hear from you. Thanks. Can U.S. equity investor also hedge against dollar devaluation simply by being long quality free cash flow generating U.S. equities? Oh, absolutely. So one of the things, so the point of this question is, why is it that stocks are up so much? Well, they're up so much because we don't denominate stocks in stocks. So we don't denominate Walmart in Walmart stock, right? We don't denominate Nvidia in Nvidia chips. We denominate them in a currency. And a US investor would base this in USD. And at the root of the question is, well, if the dollar is going to devalue, then shouldn't anything that you can own go up relative to it? And the answer is absolutely yes. So high quality free cash flow businesses, which is exactly what Berkshire Hathaway is. So Berkshire Hathaway is basically a levered play on quality companies. So it's basically a levered S&P 500. So it's outperformed the S&P over the long term. It underperforms once a decade-ish when they raise a bunch of cash, and they always raise cash right before the correction. So that's a long-winded way of saying the answer is yes, but I would argue you're better hedged by owning scarce stuff. So let's talk real estate. Office real estate now is not scarce. So I would not own, office real estate. Apartments, everywhere you go in Chapel Hill, there's new apartments being built. I would not want to own apartments. Medical office, yeah, that's not bad. I would want to own that. How about collectibles? Collectible cars, collectible wine, anything that can't be printed. Yeah, I would want to own those. How about gold? Yeah, gold's been pretty darn good. Gold, again, outperformed high quality free cash flow generating stocks for a long time, including this year. As great as this melt up has been, it hasn't been as good as gold. So I'm not against high quality free cash flow stocks. I just think you're not getting as much bang for your buck as you are by diversifying into other things. So what's the trigger for the bear market? That's the problem. You know, bear markets are tough because there is always some trigger. And, global financial crisis, it was the realization that, subprime loans were just not going to get paid, right? That if someone fogged a mirror and you lent them $300,000 to buy a house and they didn't have a job, that was a bad trade. Here it's more complicated. So you got massive problems at the consumer level. Said student loan debt delinquencies, auto loan delinquencies. The average auto loan rate is like 20 something percent. It's not the 2 or 3% the rich people get. Rents are causing real pain. Small business bankruptcies are causing mass layoffs. Job numbers keep getting revised down. So I think this time it's going to be, so in 2000, it was the discovery of accounting fraud at Cisco and AOL and all those other companies that were juicing the system. I actually think it's going to be AI this time. I think they're going to find that, all this stuff, like literally, I could go out tonight and I could buy a bunch of AI GPUs and I can plug them in and I can then depreciate 100% of them this year against my income and pay no tax. So all the rich people, that's what they're doing. So you got these companies like CoreWeave and others and Supermicro Computer. They're setting up all these data centers and all the big data companies, hyperscalers are buying lots of chips. I think it's all a scam. And I think a lot of those things are going to end up dark. I think people are going to come up with better ways to use software and more efficient ways to produce chips because we see it every day on the venture side. And, CoreWeave, it's only been public a few months. It's had 30% corrections. It's in one right now. SMCI, right, couldn't get an auditor to audit their books. And so they were going to get delisted and then magically they weren't delisted. I don't know. I think they should be delisted. I think that one's a total scam. So that's what I'll go on record saying. I think it's going to be a discovery of really bad accounting chicanery. We won't call it fraud. We'll call it the bezel, right? Um, Uh, Copy the slides. If you send an email to L Jacob uh, or Evrana, Evrana, or L Jacob, Jacob, at Morgan Creek Cap, CAP.com, they will send you the link to the slides. I can't send the slides because they're too damn big because Microsoft bloatware did something and now my slide decks are too because they use pictures. They don't save them the right way. They don't use the word compression, but we can get you a link. Um, who's Trump picked to replace Powell? So Powell is done in May of 26, so we got a long time. Um, there are 8 people on, I mean, no, there are 11 people on the list. There are the 3 front runners. And now there's 8 new people. Everyone wants this job. One, because it's cool. 2, because you get some tax benefits for taking the job. Besant is rumored. That's a good one. There are a bunch of other. There's a couple of good lists out on the internet. I I'd probably lean with Besant because remember Besant worked for Soros. Soros really likes to have his finger in the pie, so to speak. So he backs a lot of political candidates, and so my guess is there could be something there. This morning, I guess the rumor was he was going to reappoint Yellen. That I don't know. We'll see. But I wouldn't bet on any of those. I think it'll probably be somebody we don't anticipate. Just like when remember Trump appointed Powell, which is kind of the funny thing. He tries to say he didn't, which is kind of funny. I'm like, dude, we have you on video nominating him and then shaking his hand when you inaugurate or not inaugurate when you swore him in. Weird. Thoughts about real estate as a hedge against inflation, weak currency. Like I said, I don't like real estate right now at all. I think office real estate is a disaster. I think real estate debt is a total disaster. Multifamily disaster. I said medical office, maybe. I think retail, grocery anchored retail, maybe. Malls, no. They're knocking them down, creating strip malls. I just rather own Bitcoin. So seems like MSTR, perpetual motion machine. No PMM has ever maintained a perpetual. Okay. Question whether the BTC Treasury companies about when triple Qs collapse. Oh, okay. If the Bitcoin Treasury companies bow out when triple Qs collapse, which is uncertain but almost certain. I love it, Bruce. I love Bruce's questions. So look, it is true. No one's ever created a perpetual motion machine, but that's not 100% true. I mean, Berkshire Hathaway kind of is a perpetual motion machine. I mean, they basically buy high free cash flow companies and lever them up with negative cost of capital debt. It's pretty good. It's pretty good business. But you're right. Over 30 years, 80% of the S&P turns over. So companies don't last forever. And things that you think are going to be perpetual motion, like Cisco and others back in 2000 weren't. Intel was going to be the biggest company in the world, and they're not. And NVIDIA probably won't be 10 years from now. So I do think the difference here is that, Bitcoin, like gold, is money, right? It's an asset that exists in the absence of a liability. And therefore, buying Bitcoin with stock, and if you can issue the stock at a premium to the NAV because of leverage or because of supply and demand, it's a pretty good trade. Now, if the markets collapse, triple Qs collapse, people get margin called, which they will, and they have to liquidate their Bitcoin, right? Because this happened in 2020, right? Bitcoin went down 50% because people had to liquidate their Bitcoin and their cash and their gold to pay their margin calls. That will happen, and that could be a trigger for the correction. But the treasury companies don't have to sell. See, that's the beautiful thing is their debt isn't isn't callable, and it's not backed by the actual Bitcoin. People are giving him unsecured loans. That's the crazy thing. They give him zero interest unsecured loans that aren't callable. And so, as Michael says, all he has to do is issue more bonds to buy back his stock at a discount to NAV and keep it going. So it's a pretty good deal. We'll talk more about it, Bruce, but I just think it's a pretty good thing. Doesn't mean they won't be volatile. They will. MicroStrategy had a 60+% drawdown when people thought it was going to get a margin call, but they never did. So I'm not saying it won't be volatile, but I just think it is a very efficient way to own Bitcoin because of their ability to use the different parts of the capital structure, from converts to preferred to equity. All right, last one. Rate of change of assets considerably over the last 3 to 5 and year to date. Things happen faster. Significance? Okay, got it. So things are happening faster, yes. Things are going to more extreme, yes. Market capitalization weighting is the biggest reason. Passive flows are the biggest reason. Media 24/7, big reason. Derivatives, big reason. Single stock options and all that kind of. So yes, all that stuff is happening faster. What does it mean? Well, it means risks are higher. Corrections will be worse if and when they occur. The responses will probably be bigger. The money printing will be bigger. I think all of it says, like, if the market started to go down, would the Fed do an emergency rate cut? Yeah, sure. Would that stem the tide? Sure. What does that mean for equities? Well, stop them from going down. But what does it mean for things like Bitcoin and gold and other assets? Well, I mean, they go up. Because remember, they're pricing in a devaluing asset. So at the end of the day, it's a reflexivity thing. Are people's weightings in equities higher because prices are higher, or prices higher because the weightings are higher? The latter is better than the former. I think it's more the former. And so I think there's just this reflexiveness going on, to quote Soros. And in the end, when it turns, it will be uglier. And, another catalyst is sales, right? The boomers eventually got to start taking the money out. They've been putting money in for 40 years. They got to start taking money out to live because they're retiring in droves. So that certainly is part of it. And the next generations don't have as much money yet. They will. So I don't know. It's a good question for us to think about. Probably something we'll talk about in September. We're a little over time, so I will let everybody go, and I hope you enjoy the rest of your summer. Thanks for hanging out. This is a great turnout today on a hot August day, and we'll talk to you soon.